Hi, everybody. Welcome to this edition of Kuvera Insights. We are going to be speaking today with Cheenu Gupta from L&T Mutual Fund. We are going to talk about ELSS schemes. This is especially relevant now. This quarter is the quarter of when everybody makes their tax saving investments. But we will, cover this and much more in detail during our discussion. While this is, while we focus on selected topics, but you may always come back with if there are any questions or comments, you can come back with those, and we will try to, get a response to those as well. So, warm welcome, Cheenu, to this discussion. We'll start with a quick introduction. So Cheenu is the fund manager, equity investments with L&T IM. Before L&T, she was the equity fund manager with Canara Robeco AMC. And she's managed multiple funds there, including the equity tax saver, equity hybrid, consumer trends, small cap and infrastructure funds. Prior to that, she was with Tata AIA Life Insurance. Again, on the investment side, she was with ING Investment Management as a senior research analyst, as well as before that with UTI Mutual Fund as an analyst. Cheenu is a CFA charter holder and has completed a PGDM from SP Jain. She's a gold medalist in her finance specialization, and she's a engineer by. She did her engineering for a graduation from VESIT, that is Mumbai University. So welcome, Cheenu.
Thanks, Neelabh. Thanks for that introduction.
So we'll quickly jump into our topic for today. And so what, can you just explain in brief, what exactly is ELSS?
So ELSS, if you see, it stands for Equity Linked Savings Scheme, right? So here the investment in this has been made tax-free by the government, and the lock-in period in these schemes is 3 years. So if I have to just talk about the objective as such, ELSS is there to meet the dual objectives. One will be the long-term wealth creation, which is happening through investment in equities. And second is the tax-saving objective, which is equally important.
Right. So how are ELSS mutual fund schemes, equity linked savings schemes, how are they different from other mutual fund schemes?
So if you look at the construct of these schemes, they are actually very similar to any flexi-cap or a multi-cap mutual fund scheme. Right. Just that here we know that the investor is there for a minimum period of 3 years or more. So as fund managers, if we are constructing the portfolios, we can invest in trends or turnarounds, which can take some time to play out as well. So that is a benefit. Similarly, the investor, if you see in the scheme, they are investing with a minimum time horizon of 3 years. So they would be the ones who would not be very concerned with near-term volatility in the market. And this gives some stability to the scheme.
Right. So, is it okay to understand it like this, that from an investor's perspective, they get to save taxes, and from a fund manager's perspective, because they have visibility of that balance or of that investment amount remaining with the scheme for a period of 3 years, they are able to better plan their investments or the scheme's investments, and this could potentially translate into better decision making from a scheme's perspective.
Very true. I think you perfectly put it in words.
Great. So you mentioned that otherwise, apart from these differences, ELSS schemes are very similar to other mutual fund schemes. Do ELSS mutual fund schemes also have some kind of categorization, or ELSS scheme of one mutual fund house versus ELSS of another versus of a third one? They are all, will they all be similar?
So generally, if you see, ELSS schemes are not very focused either on one segment, say a sector, or similarly, they do not usually have a bias, like fixed large cap oriented or mid cap or small cap. Usually, most of the fund houses run ELSS schemes benchmarking to either BSE 500 or a Nifty kind of benchmark. And here comes the very diversified nature of the fund. So across fund houses, you will see that you have a good mix of large cap, maybe around 60-70%. Then you have mid caps around 20-25%, and then maybe some bit of small cap as well. And in fact, if you see, this diversified nature itself reduces the overall volatility of the fund. And the way we call it, that they give the best risk-weighted returns to the investors over time. So that is how I think the diversification in this scheme is very helpful to the investors. Another thing which I can say is, again, because of this diversification, investors need not be too worried about timing investment in these schemes. Like if somebody is particularly looking at only a particular mid cap or a small cap scheme or a sector oriented scheme, you need to time it to understand where that sector is placed or that particular category of market cap companies are placed. But here, because of the diversification, I think even that timing would not be very important for the investor. So one can freely invest as per one's convenience.
Understood. So now in terms of, where ELSS schemes can invest from a SEBI mandate standpoint, is there any guideline or any restriction which says that the fund manager cannot invest in certain segments or stocks?
So if you look at really when it comes to SEBI restriction, there is as such no real SEBI restriction on the fund manager for investing in ELSS schemes. If I rather compare it with other schemes such as diversified or large and mid cap schemes, there are some cutoffs as to investing in large caps or mid cap or small cap. However, for ELSS, there is good amount of flexibility, and the fund manager can judiciously pick these winners freely across market caps.
Right. So, from what we, just to sort of summarize in brief, ELSS schemes are not particularly under any restriction, but in general, given the longer term nature of the investment from an investor standpoint, fund managers generally choose to keep a well diversified portfolio when investing into an ELSS. Is that a fair? Okay, so coming to the other aspects of ELSS, and let's say traditionally the preferred mode of saving taxes was EPF and PPF, and maybe life insurance and so on. EPF, of course, is a segment where it's almost a compulsory deduction from an employee's salary, and therefore it takes away some of the amount that you could invest in against the 1,50,000 limit. But keeping that aside for a moment, how does ELSS compare with PPF, EPF, and life insurance? If you can just throw some light on these three cases specifically.
Yeah, sure. So let's start with first off one of the strength of ELSS. So ELSS is a very good option if I talk about maybe the younger generation or anyone with good earning time frame horizon ahead, and this person is also focused on tax planning. So considering the good horizon of investment, one can really benefit from the India growth story. And you do that by participating in the equity market. You are actually growing your invested money in line with the growth of one of the best companies in India. So this is how equity provides you with the real power of compounding over longer term. And if I have to talk about another benefit, it is obviously that ELSS has the shortest lock-in period versus all other tax saving options. So when you talk about all these options like insurance, NPS, fixed deposit, PPF, etc., here the lock-in period can vary from say 5 years to 15 years or even up to retirement. But here in ELSS, it's just 3 years. So that is the second benefit, I would say.
Understood. So flexibility, both from flexibility and possibly better returns versus PPF, EPF, and LIC or life insurance policy traditionally. So PPF or provident fund traditionally was considered to be, the retirement corpus that one would create. A provident fund से घर खरीद के उसमें retire होके रहेंगे, right? So if you do that with ELSS instead of PPF, there is potentially you can earn that much more income and therefore retire into a larger house.
Very true. In fact, whenever one talks about large horizon of time, this is where the real power of equity comes in. In near-term, equity can be volatile, but whenever you compare it over longer time frames, it's always the equities which have by far delivered kind of better returns versus all these options.
Right. To be fair, though, in in the favor of provident fund, it is one of the most attractive from a long-term safe investment perspective. Isn't that correct? And provident fund does have a restriction of 15 years, unless you specifically. At least PPF does. Right? So that's a positive in favor of PPF. But in general, ELSS from a long-term investment horizon, there is a significant. It won't be right to call it alpha, but there is a significant reward for taking that additional risk that may be available for investors who are willing to explore this as an option, apart from tax saving, of course. So now, coming to in terms of amount, there are lot of investors who want to understand what is the limit, how should we identify how much amount should we invest in ELSS. And the second part of the same question is that most of the time this planning happens at the time of tax filing or when the employer comes and asks for investment proofs. So everybody wants to do that calculation that day and make that investment on the same day. So it becomes like a lump sum, one-time lump sum. So is there a better way? One, how much should you invest? Is there a better way to plan this investment?
I think well said. So when one is looking at investment, one can look at any amount, right? One can look at smaller portions or to the entire ATC benefit that we are talking about, that 1.5 lakh. So that entire benefit can be used for investing in ELSS, or it can be even smaller amount. And why just have a lump sum investment? Tax planning is something we all know we need to do, but let it not be the last minute rush. One can actually plan smaller SIPs throughout the year. So it can be a monthly investment that you can make into ELSS. So towards the end of the year, you already invested for this tax saving incentive.
Right. So SIP, the systematic investment, is the holy grail for folks who have regular cash flows or salary income. I can probably point out two benefits of following an SIP route instead of doing a one-time investment. One is that in the last month when you are making that investment, a large part of your salary doesn't go suddenly towards this investment, and you feel sort of deprived of funds at that point in time. Or you have to make a decision which is less than favorable for you from a tax front and invest an amount which is lesser than required. And secondly, ELSS are being mutual funds and being the target investment being equity. You do get the advantage of get to capture the market movements. So for certain months, if the markets were depressed or were down, then if your investment is spread out throughout the year, so your overall cost of acquisition per unit of that mutual fund scheme will come down.
Very true.
So that's great. And in terms of the limit that you mentioned, so 1.5 lakhs. as per the Income Tax Act, that is the limit available under the section. So one should do a calculation of whatever is sort of committed by way of the EPF. If there is a life insurance policy, then what is the premium to be paid? Subtract that away from 1.5 lakhs, and you can then come to a amount that needs to be invested in ELSS, and then spread that through the year if you can.
Right, and I think one should not forget that again, ELSS schemes are just like other mutual fund schemes. So although you are doing it with a tax saving objective, you're also doing it for wealth creation. So many a times there are people who have already met their 1.5 lakh limit, and even then they are investing in these ELSS schemes. You have that self-discipline that you will be invested for 3 years. You're not worried. You're not looking at your money for 3 years. So there's no nervousness about what is happening in the markets for next 3 to 6 months or shorter time frames. And as I said, the returns of ELSS schemes are like at par with the other schemes in the market. So yeah, one can also consider investing in these schemes as part of alpha creation.
Right. So are you saying that if let's say you were to set up an SIP, hypothetically, if somebody were to set up an SIP for 10,000 rupees a month, and you can just stick to that SIP amount even if your EPF limit is higher, just because investing in ELSS comes with comes with certain sort of, we can position it as an advantage that you are blocking funds, so you are not tempted to withdraw or utilize them or use them for consumption. And even on its, even keeping the tax saving aside, ELSS returns would be possibly comparable with the scheme categories. If you were to compare like-to-like scheme categories, then ELSS returns could potentially be comparable in those.
Definitely.
So it's not like after the lock-in period is over, then you should withdraw your ELSS scheme and put it into an active.
No, I think one can treat it just like the way you're investing in other mutual fund schemes. So there's no reason one should withdraw.
Right. So keep investing, build a corpus, and withdraw only when you need it.
When you need it, yeah.
Sounds good. So now, in terms of investing into ELSS, is there any category of investor from a professional aspect? Is there any category of investor or life stage who should not consider investing in ELSS, or conversely, who is this ELSS product suitable for?
So as I said, ELSS one is definitely for those who are focused on financial planning, because as part of financial planning, you're doing tax planning. So ELSS has a stronghold here. Secondly, people who are looking at wealth creation over some time frame, ELSS is for them. Again, as I said, there are various wealth creation opportunities available over longer periods of time, and one can choose this option very early in life. So definitely ones who are just, at the cusp of beginning their financial planning or their journey, or in fact, even ones who have good time frame of earnings ahead of them, as I mentioned earlier as well. All those people can look at investing in ELSS and benefit from the power of compounding. It's only people who are towards the later stages, closer to the retirement, where I would say that, okay, one could have some caution and not look at ELSS for tax saving, where you are very close to your retirement. Right. Apart from that, I think for all other categories, this serves as a very good option.
Got it. So it's like so this fits into a glide path approach to investing, right? As you are nearing the goal for which you are saving, which you are putting aside money. If somebody is saving, buying a house, if they are investing by way of an SIP into an ELSS fund or even any other fund, for example, as they are nearing that goal, which could be retirement, like you mentioned, or it could even be purchase of a car, it could be buying a house. But if you basically, as you are nearing that financial goal, as you are nearing that end objective, that this is what I'm saving for, you can slowly start de-risking your portfolio. So if your goal is, let's say, 3 to 5 years away, then you can start reducing the amount of equity, the asset allocation, from an asset allocation standpoint. You can start reducing the amount of equity into your portfolio and moving into sort of less risky, less risky investment. So that's thank you, Cheenu. That's been very helpful, and I hope our users find this to be very insightful. In case we have any further questions from the audience, then we will come back to you. And it was great to have you on this. We hope to have you again.
It was nice interacting. Pleasure.